All right, let's get started with the first conversation of the day, and that has to do with fixed income instruments and investments. Now, traditionally, when these instruments are spoken of course, we speak about debt mutual fund schemes, we speak about fixed deposits, but you generally tend to look at debt investments as relatively short term compared to equity. Everyone agrees that equity should be a long term investment. But there is a case to be made in investing in long term debt instruments as well, or debt mutual fund schemes. And there's a very clear benefit of investing into debt mutual fund schemes as opposed to fixed deposits. Joining me now to talk about both of these aspects in more detail is Prableen Bajpai, the founder of FinFix. Thank you so much, Prableen, for joining in. It's of course often been said that debt mutual funds are superior to fixed deposits. Why is that? Could you take us through the key reason?
Good evening, Alex. Great to be here. Absolutely, Indians love fixed income products, Alex. And I think, fixed deposits, of course, is a very huge component of the fixed income basket for any investor. And when we talk about mutual funds, I think primarily what people look at is equity mutual funds. And I think debt mutual funds are quite underutilized. There are a couple of key benefits, I feel, which debt mutual funds offer over fixed deposits, and I like to list them out. I think number one being that whenever a fixed deposit is made, a lot of people do a FD, considering that they would not even use that money or the interest receipts during the year, and it may just get reinvested again the next year. But all of that, the interest payments are actually taxed during the financial year. That means whether you use the payout or you take a payout or you don't, you still have to pay a tax on your interest receipts from fixed deposits. And that's not the case in debt funds. Debt funds kept for a year, 2 years, till the time you are not redeeming them, you do not pay any tax on them. So the taxation is only, it comes into picture once the investment is redeemed. I think that's one first clear benefit. Second, the profit and loss of any debt mutual fund can be utilized to set off against a profit and loss in an equity investments. Majority investors have equity investments. So for example, if I had a loss in an equity mutual fund and I've carried it forward, which can be done for 8 financial years, I can set it off against a gain, which is there in my debt fund, the capital gains. This advantage, again, is not there in a product such as fixed deposits. So I think this can really reduce your taxation for investors. Thirdly, Alex, a lot of especially senior citizens, investors who are dependent on fixed income for their day-to-day monthly needs of money are dependent on the interest payments from fixed deposits. Debt mutual funds offer a tool which is called the systematic withdrawal plan, which is also there in any of the mutual funds, wherein you can decide on a certain amount which you want to redeem on a monthly basis. And this SWP, because this component includes a bit of your appreciation of money as well as your principal, the taxation which falls on the investor is much lesser as compared to somebody who's using just purely interest receipts from fixed deposits. So that's another advantage. And I think fourth one is, of course, the post-tax returns due to the indexation benefit, which debt funds offer.
Often we speak about indexation, but let's talk about this in more detail so that my viewers understand why there is such a big benefit. How does this indexation work, and why is the post-tax return superior?
Alex, let's first understand what exactly is indexation. So indexation is more like just recalculating your purchase price in line with the inflation in the economy. So the government is reasonable enough and they say, fine, you're investing in an investment and we are okay not taxing you till the time your asset is growing in line with the inflation, because they want you to ensure, they want that the purchasing power of the investor is retained. So the government takes out a certain index, which is called the cost inflation index on a yearly basis. So it is a number. And whenever the calculations for taxation for debt mutual funds are done, they use this cost inflation index for the calculation purposes. I'll give an example here. Let's assume that I had invested 10 lakh rupees in the year 2010-11 in January or February of, let's say, 2011. And over this time period of 10 years, it more than doubled, and it grew up to about 22 lakhs and 50,000, which is about 8.1 to 8.2% returns. Now, not considering that fixed deposits are taxed on a yearly basis, if we just put all of that aside and we see that what is our profit here, my profit here becomes 12 lakh 50,000. So that is the amount which can be taxed now, 12 lakh and 50,000, because I have earned that over this 10-year period. Now, if I'm in a 30% income slab, how much tax do I pay? I pay a tax of about 3 lakh 75,000 here. If I'm in the 20% slab, I would pay a tax of about 2 lakh 50,000 here. But that's not how my debt fund would be taxed. I will be calculating that during the year of sale, how much should my asset have ideally grown to? So I use this indexation technique. I factor in the CII number of the year in which I have sold the asset, divided by the year in which I had purchased the asset, multiplied by my original purchase price. And if we put all of this together, my inflation adjusted purchase price becomes a little above 18 lakhs, which means, Alex, that the government is okay not taxing me till the time my profits are capped at this 18 lakhs. But because I had earned 22 lakhs 50,000, I will now pay a tax on the remaining amount, 22 lakh 50,000 minus this 18 lakh, which is about 4 lakh 45,000 odd. And on this, I pay a 20% tax, which is only 89,000. So this substantially reduces the tax which I pay on my investments. And this is, Alex, just, the CII in the year 2010-11 was 167. Because I sold my investment in February of 2021, the CII was 301. And you would have also come across that a lot of people say that you invest in March end and then you redeem in the April of a new financial year. If the same investment was redeemed, let's say by me in April of 2021, my tax liability would have further gone down to only 70,000, because the CII for the fresh financial year would have come into play, which was 317.
Understood. The onus, Prableen, of calculating this is on the investor, right? And you have to pay long-term capital gains tax as and when it has to be paid. And usually if it's a large amount, you have to pay in advance, right?
This is only after redemption, Alex. So somebody who's keeping an investment for 10 years doesn't need to pay an advance tax. Only when the investments are redeemed, the calculation is done. And according to that, because here the month of sale and purchase is very important, whether it is March or April, because that changes the financial year. So based on that, the calculation is made. And this,
I meant exactly that. When once you redeem it, assume. Absolutely. Absolutely. Let's talk about the construction, Prableen, of a long-term portfolio. Let's talk about the construction of a long-term portfolio, because by its very nature, if you talk about when long-term capital gains tax becomes applicable on a debt mutual fund scheme, it is 3 years. So the assumption is that you have to hold it for at least 3 years for the gains to become long-term. But yet, I think a lot of people think of these investments as short-term in nature. Why is it important to have a long-term approach also when you're building a fixed income portfolio?
I think, Alex, that's a very, very important question, because, a lot of us actually ignore having a solid fixed income portfolio. All we consider is equities for the long term. But if we traditionally see, PPF, EPF are actually long-term fixed income portfolios, which investors actually hold. That's the component. But all of these have a lot of restrictions when it comes to redemption, though they do offer the tax benefits on redemption. But there is limitations on how much you can withdraw. Having said that, having fixed income in your portfolio is also the, it is sort of the fundamental of a strong portfolio overall, because your asset allocation needs to be maintained. And I think fixed income, a lot of people I know and I think I interact with do have a decent amount in their fixed income baskets. But I think it's not very properly allocated, because all they do is they park it in the FD and it keeps getting reinvested at whatever interest rates are there in the economy. And I feel that if this part of their portfolio can be channelized into, debt funds or long-term debt funds, it can actually give them much better post-tax returns. And I think thus there is a very strong case why this should be seen. And of course, the percentage allocation to fixed income products would depend on the risk appetite and financial goals of the investor. So it is not just the conservative investor who should look into this. This is sort of the conservative part of your overall portfolio, which any investor should hold.
Okay. Now, often, Prableen, we speak about passive investment or passive strategy for equity, but there's also passive strategy available for debt. Is that something to consider when you're constructing the core of your debt portfolio?
Yes, I think that's a very good segment, which is comparatively new in India. We have about now 35 to 40 schemes in this space, Alex. And passive funds, I think, negate two very crucial as problems which debt funds have been facing. Number one was the credit quality, especially after the Franklin fiasco. We did see a lot of exit from debt mutual funds, and all these passive strategies which are there in India in the debt segment are focused on either government securities, state development loans, oblique the bonds of public sector enterprises. So the credit risk here is almost negligible. And of course, because they are usually for a longish time horizon. So they are, in a 3 to 4 year to 5 year, even a 10-year product is available. I think it makes a case because other than the interest rate volatility, which may be there, the credit risk goes down to zero. And I think passive strategies are low cost, and they actually can form the core of your debt portfolio. And these particular products are actually they are just tracking a customized index. For example, the Bharat Bond ETF was launched, and the 2030 Bharat Bond ETF is tracking the Nifty Bharat Bond Index. So I think it's a very good strategy. Multiple financial years can be covered, and the credit risk is not there. Just that the investor needs to stay through the intermittent volatility in the product.
Okay, now another slightly more involved process when it comes to construction of a debt mutual fund scheme is to use target maturity funds, right? So you say that you have a requirement in 2027, maybe. You have a particular target maturity fund that culminates in 27, then you have requirements in 28 or 29 or 30 or beyond that. And there's also a strategy, Prableen, that is the use of a debt laddering strategy. Could you explain that and give us a few examples of these target maturity funds?
Absolutely. So even the, majority of the passive strategies, Alex, which are available in India are actually target maturity products only, because a customized index is created. And the best part is that the investor knows right in the beginning that there is not only visibility of the likely portfolio that that particular instrument will be having, also there is predictability of returns if you stay invested till maturity. So there are a couple of these indices which have been created. A lot of funds have come up. So this debt laddering strategy is basically that you're parking your investments in a way where you're able to cover the different interest rate strategies, in the sense that you have something maturing in 2024, then you have something maturing in 2026. So based on your needs, you can have products which are giving you the predictability of return for that period, and your financial goal can be taken care of. Not every investor would require more than one or two debt funds. But of course, what is important here, these target maturity funds, is that you need to align the time horizon along with your financial goal. So if my financial goal is 5 years away, then I need to choose a product which has a target maturity of 5 years. So there is alignment of the two things. Otherwise, there are chances that I need to exit during a period of volatility, or when there is a, let's say intermittent dip in the NAV. So that would be bad for my overall returns. So it is very important to align the two things and then invest. And some of the strategies available here, I'll give you an example. For example, there is a Axis CRISIL SLDL 2027 debt fund. So now this one is a construct of purely state development loans, which would mature in 2026 December to May 2027. So there is maturity, when this product is going to mature. Then there are certain products which are purely government securities, like the IDFC Gilt 2028 Index Fund. It is just tracking two government bonds. So one is giving them 7.17% returns, one is going to give them 8.28%. So they're just going to track these. And Alex, again, some other ones are a combination of these state development loans mixed with a PSU bond like Edelweiss has come up with. So these are very interesting strategies. There is predictability of returns, but the catch is that the investor needs to align his investment horizon with the target, that maturity period of the product.
So for example, if there is a Shadi in 2030, you use a target maturity fund that culminates in 2030. Very simply put.
Absolutely.
Prableen,
Absolutely.
Thank you so much for joining in and for clarifying these unique ideas within the debt fund strategy, because I think that the more we talk about these things, the more usable they become. Thank you so much for taking the time.
Thanks, Alex. Thank you.